Hello everybody, this is Rick Geiler with SilverSide Insurance Marketing here in sunny Tempe, Arizona, and welcome to the February presentation of Asset Management Strategies in SilverSide. And as usual, I have Tony Fiorillo, the principal of AMS from Indianapolis, Indiana with us today. And we're going to focus a little bit more empirically today. In some of the past, we've gotten into a little bit what we thought the political climate and some of the other factors were going to drive the markets and drive the numbers. But today, we're going to look empirically at charts and rates and data. So the expert on that is Tony. So if he's ready to go here, I'll get it over to him. Hi, Tony.
How you doing, Rick?
I'm doing well.
Yeah, we wanted to talk a little bit about the technical data, and we've got some charts and graphs to support that. I promise we only have just a handful of them that we'll walk through, but I think they support a lot of the empirical information about where the economy, where the markets really are, instead of the fundamental approach and the kind of gut instinct to where the markets are. I'm reminded, when we look at these, we can pull up charts and graphs to support any viewpoint. As the saying goes, if you torture any data long enough, you can get it to confess to whatever you want to. So we could pull up charts that would show you all the horrible things about the economy, all of the reasons that the market is on the verge of a collapse. And we're trying to be subjective here. We're not just trying to show you the good, we're trying to show you the challenging as well. But the beauty of our investment approach is we don't have to have an investment bias that then we have to go out and find data to defend. And if you look at a lot of these strategies, that's what you'll find, that they have a certain bias and a certain viewpoint, and then they're constantly looking for supporting documentation to make that argument. A couple things I think are enlightening that we pulled out of this Goldman report, which has, I think, 90 different exhibits, so we just pulled a number of them out. One of the things I think that is worth looking at is this is a chart that shows CFO optimism about the economy. And as you can see here, we're up to a pretty high level, even higher than where we were coming out of the recession at 2010. We're not quite back to where we were in the early 2000s, 2004, but still this is definitely an improving situation. This chart shows the change in financial sector leverage. One of the things that has slowed down this rebound of the recovery is that individuals are not investing as much, they're saving, they're paying down debt, but also institutions are paying down debt. You can see how this the red dotted line is the previous recoveries after World War II, and you can see how that's kind of baseline for where these recoveries have come. The current recovery is showing that these financial institutions have been paying down debt. So if they're paying that debt down, that means that they're not infusing that into the economy, which slows the growth rate down. This shows the household leverage through the same recovery. Again, pretty much the same average here. Trend line as you're looking at this recovery from World War II. And you can see how individuals have been paying debt down. That's a pretty dramatic difference from what the average recovery period looks like. It's good for people personally to pay debt down, but it's not necessarily good for the economy because our economy is 70% based on consumption. If people are saving more money, if they're investing more money, then it's harder for the economy to come roaring back. This chart shows the pace of the recovery, and as you can see here, the bottom line, all starting at a zero baseline, we have 10 different economic recoveries since World War II. And in each one, it shows how long they ran, which is the number of quarters along this line. And some of these, the one from 1991, was a long recovery, 40 quarters almost. That's 10 years that ran. And you can see how these kind of fall into a very similar pattern. But the red one at the bottom is the current recovery since the second quarter of 2009. And you can see it's the lowest percentage gain in cumulative growth percentage against this axis. And we're still out here getting out somewhat long in the tooth in this recovery. We're not out 40 quarters like we were here in 1991, but 28 quarters is certainly more than enough to get this recovery going, and yet we're still at about 50% of the pace of what the average recovery has been. This chart shows the change in U.S. personal savings rate, which again is a good factor. This is what the average has been since these most recent recoveries. The red dotted line is the current, I should say. The median is the solid blue line, and the light blue is kind of the range of where it's been. So if the median is that people reduce their savings rate, meaning that they spend more money, that's positive for the economy, generally positive for the markets. In this red dotted line, which is the current, they've actually increased their savings. So good for them. You know, they're putting more money away, but it doesn't necessarily infuse that capital into the economy, which can be an explanation for part of the slowdown of the recovery. This chart shows the U.S. labor force participation rate. You can see back here from the 1950s and the 1960s, I think you see, you know, a pretty strong increase as the percentage of the population that was working went up and peaked here in the late 90s. We had pretty good economic growth throughout this period. I think part of this is explained by the fact that we have, at this point, we started having two-income families. So you had husband and wives both going to work at this point, to the point where it kind of peaked here, and then it fell off. If you look at where that peak was, roughly 1998, if you remember, that was after a strong growth rate in the stock market, right about here at year 2000. And also somewhat of a change in government political stance, where we've expanded people that are collecting welfare and disability. So if you look at this point right here where the market peaked, that created an enormous amount of wealth. When the peak of the employment number shows that there were some people that, because of that increase in wealth up to that point, they could afford to retire early, and so they left the workforce. Then combined with that, you also have more people that are on disability, more people that are collecting welfare, and we've seen roughly a 5% decrease in the percentage participation rate. What that means is that there are less people that are making higher incomes and paying taxes, and again, this kind of slows down the recovery rate. So this chart shows the National Association of Home Builders, the Housing Market Index. And you can see this huge dip from where we were at an artificial real estate market that we created this bubble going into 2006. And the home builders housing market index started to drop pretty dramatically and bottomed out here just after the financial crisis in 2008. Since that time, it's made a pretty strong recovery. We're almost back to the peak of where we were before that collapse. This is important because roughly 25% of our economy is based on the housing market. You know, people moving from house to house, building new houses, the employment, the purchasing of new materials. You know, this is all very positive for our economy. This number at this historic, you know, challenging this historically high rate is very, very positive for the economy overall. Unfortunately, during this time, this shows the change in U.S. government, U.S. budget balance following recessions. And if you look at these different recessions that we've got recorded, what typically happens is the government reduces their budget balance. And the average is this blue dotted line. The average of all of them collectively is the solid blue dotted line, or heavier blue dotted line. And what you've seen in almost all of these recovery periods from the recession, that the government reduced spending. And that's not what's happened in this one. The government has actually increased spending here since 2009. So as the government keeps spending more money, that takes more money out of the hands of the consumers, that increases that debt and slows down that recovery pace as well. This chart shows the prospective total returns by the investment strategy group. This is a collective of a number of different indicators that they look at to see what they think that the return is going to be. The blue line is for the year 2017. The green line is what they expect for the next 5 years. And you can see what they're showing here for 17 and the 5 years on the S&P 500 is about a 3% growth rate. That's not very promising. So I think that what the collective consensus is that we're going to have a very slow, very gradual increase in the markets, not just this year, but for the next couple of years. Shows the U.S. equity volatility, and as you can see, since 2005, we've had a couple of events here. Here's the global financial crisis. These spikes are not increases in the market, it's increases in volatility. And of course we had hyper volatility at this point. A couple of other events that we've had, the first Greek bailout, the debt ceiling increase, and the S&P 500 downgrade was at this point we saw a little more volatility. We had the actual Greek default, which is back here in 2012. Since that time, we've had a couple of other events. Here in 2016, we had the British exit issue in the summertime. But if you'll notice, these are a little bit more well-behaved from a volatility standpoint, and we've been at that pace basically since early 2012. We certainly haven't had any volatility like we've had back here. So if you look at this over a long period of time, you're starting to see a little bit better behaved market. It's not so reactionary. It's not so exaggerated as what you had in certainly this point. This was pretty much a black swan event. This is the kind of thing that we would expect to see, only once every 25, 30 years in the stock market. But that doesn't mean that it can't happen, and it can't happen again, very quickly. It doesn't have to behave that well. But what we're seeing here is definitely a trend line where we're seeing the peaks of these volatilities at lower levels as we go along. So I think that's showing that people are starting to get more comfortable with the markets and the economy, but you never know. One of the biggest problems, this chart shows the U.S. equity and bond mutual fund flows, and what you see is that since 2009. There's been a pretty significant increase in dollars that are going into bond funds, which you could argue that as we're at a point now where interest rates are increasing, that the worst place to be would be bond funds. But you've also seen, since 2009, a pretty systemic withdrawal from equity funds. This equity fund trend line should be much higher. The markets have performed fairly well. The volatility has been pretty low. The economic outlooks are, if not rosy, not devastating, so that we can sustain this slow growth coming out of here. You would expect to see this inflow into equity mutual funds much, much higher. I think the reason that we don't is because people have seen 2 catastrophic market meltdowns in the last 17 years, and they're just gun shy of the markets. So this explains why we have $13 trillion sitting on the sidelines making next to nothing that can go into some type of investment. So that's all the charts and graphs that I have. I hope that doesn't put everybody to sleep looking at all those, but I think that some of those are meaningful numbers that show, give you an indication of where the market is and where the economy is.
Well, to boil it down, in a nutshell, it kind of looks like, from an empirical standpoint, that we are on a slow, steady recovery, and the markets are responding accordingly. What kind of outlook, and I know we're trying to stay as empirical as we can today, but moving forward 2, 3, 4 years, what kind of outlook might this indicate?
Well, I think what we're showing here is really the data, the data-driven explanation for where the market and the economy is and where it's likely to go. You can't ignore the fundamental issues. A new administration that seems to be intent on kind of rattling the cage a little bit. If they continue to strip away regulation, that can have a very, very big impact on the economy, and it can happen very quickly. And I think that we'll start to see that reflected in higher earnings growth numbers for these companies. And I think what we've seen since the election is really just an optimism boom. that we've had this rally. Some people call it the Trump rally, but I call it the optimism rally. That people are looking at what the world could look like if we had government at its back instead of constantly erecting hurdles in front of it. So I think that it's yet to be seen if the administration can pull that off, but that's certainly the stance that they're intending to take. And if they can do that, it can be very powerful for the economy and therefore the market. So as we sit right now, the market is pretty fairly valued. Some would argue a little bit overvalued, but most of the consensus from a lot of the prognosticators are that the economy is not going anywhere and that it's going to continue this slow growth pace. And most of them have more concerns with China. If their growth rate slows down dramatically, that can have ripple effects around the world. But there are also great valuations in Europe and emerging markets. Those stock markets have not run up over the past few years, and yet those companies are still making more and more money. So, again, we don't have to make these predictions. Our strategy is not to take a position and then try our best to defend it. We'll react to whatever price movement comes to us. If that price movement is on the upside, we're happy to stay invested and collect the returns. If that price movement comes dramatically on the downside, we're not going to sit on our hands and just wait and tell clients to sit tight, it'll all come back eventually. Our models will react to that and get us out of harm's way if this market sells off and continues to accelerate that sell-off.
All right. Well, we will have more data to look at on next month's call, and I hope everybody will join us for that. In the meantime, if you would like to know more about how to get involved with SilverSide and AMS with Tony and his team, go ahead and give us a buzz here, 480-998-1286. So thanks.
Having me, Rick.